Most people treat life insurance like a black box, a monthly bill they pay into a void, hoping they never actually have to use it. But what if I told you that life insurance isn't just a safety net, but a sophisticated bet on your own mortality, where the math is rigged in favor of the house? Whether life insurance is a simple protective shield or a powerful investment engine depends entirely on which of the three pillars you choose. In this definitive guide, we are going to dismantle the complexities surrounding the insurance industry by comparing the three primary vehicles used to protect families and build wealth: term life insurance, whole life insurance, and universal life insurance. To understand why these products exist and why their prices vary so wildly, we have to look past the marketing brochures and start with the cold, hard mathematical foundation of the entire industry: the concept of exponential mortality. The engine of insurance: exponential mortality rates. The primary reason life insurance exists, and the reason it can become prohibitively expensive, is that human mortality does not move in a straight line. It moves on an exponential curve. In plain English, this means that your likelihood of dying does not just increase as you get older. The rate at which that probability increases actually accelerates every year you remain on this planet. To visualize this, imagine a graph where the horizontal line, x-axis, is your age, and the vertical line, y-axis, is your likelihood of dying. For your 20s, 30s, and 40s, that line stays relatively flat, hovering near the bottom of the graph. But as you hit your 50s and 60s, the line begins to curve upward. By the time you reach your 70s and 80s, the line shoots almost straight up like a hockey stick. Let's look at the data to prove this point. Based on historical statistics from the United States, the odds of a 40-year-old man passing away within the following year are roughly 0.2420%. This translates to about 2.42 deaths out of every 1,000 men. Just 1 year later, for a 41-year-old, that risk moves to 0.2530%. By age 42, it hits 0.2663%. While those numbers seem small, look at the increase between the years. The jump in risk between 40 and 41 was 0.11. The jump between 41 and 42 was 0.133. The gap is widening. As you age, the steps up the ladder get taller and steeper.
If you were to buy insurance 1 year at a time, what the industry calls yearly renewable term, your premium would follow this curve exactly. It would be incredibly cheap in your 20s, perhaps only $10 a month. By your 40s, it might be $20. By 60, it might be $100. But by the time you are 80, the risk of death is so high that the insurance company might demand $1,000 or even $2,000 a month for that same policy. At that point, the insurance becomes unaffordable, precisely when you are statistically most likely to need the payout. 1. Term life insurance, the temporary solution. Since most people cannot handle an insurance bill that doubles or triples every few years in old age, insurance companies created a product that levels out the cost over a specific period. This is term life insurance. Think of term life as renting your protection. You decide how long you need the coverage, the term, which is commonly 10, 20, or 30 years. The insurance company looks at the exponential mortality curve for those specific years, calculates the total risk, and then divides it into equal monthly payments. In the early years of a 10-year term, you are technically overpaying for the risk of a young person dying. However, in the later years of that same term, you are paying significantly less than the actual cost of the risk. The company is essentially averaging the cost, so your bill stays predictable. The renewal shock. The biggest caveat with term insurance is what happens when the term ends. Let's say a 30-year-old buys a $250,000 policy for a 10-year term at a price of $15 per month. For a decade, that price is locked in, but on the first day of year 11, the term is over. If that person wants to keep the insurance, the company will reset the price based on their new age, 40, and the new mortality risk. Suddenly, that $15 payment might jump to $100. If they try to renew again at age 50, it might jump to $300. Because of this, term insurance is considered temporary insurance. It is designed to cover a specific window of high financial vulnerability, such as the years you are paying off a mortgage or raising children who depend on your income. Most people find that by the time they reach their 60s or 70s, their house is paid for and their children are self-sufficient. At that point, they allow the term policy to lapse because they no longer have a need for the coverage. 2.
Whole life insurance, the permanent solution. Some people have financial needs that don't go away after 30 years. They may want to ensure there is money for a funeral, to pay off estate taxes on a family business, or to leave a guaranteed legacy for their heirs regardless of when they die. For these people, whole life insurance was created. If term is renting, whole life is owning. It covers you for your whole life, whether you pass away at age 35 or 105. Because the insurance company knows with 100% certainty that they will eventually have to pay a death benefit, because everyone dies, they have to price the policy very differently. While a 30-year-old might pay $20 a month for a term policy, they might be asked to pay $200 a month for the same amount of whole life coverage. The mechanics of cash value, or reserves. Where does that extra $180 go? It goes into what is called the cash value, or the reserves. In the early decades of a whole life policy, you are massively overpaying for the actual risk of dying. The insurance company takes that excess money and invests it. Over time, that money grows, creating a pool of cash inside your policy that you can actually borrow against or withdraw. This creates a fascinating shift in risk. Imagine you have a $100,000 whole life policy. In year one, you have almost no cash value, so the insurance company has $100,000 of their own money at risk. But 40 years later, if your cash value has grown to $60,000 through your premiums and interest, the insurance company only has $40,000 of their own money at risk. If you die, they give your beneficiaries your $60,000 plus $40,000 of their own. By the time you are 100 years old, the cash value might equal the full $100,000. At that point, the company has zero risk. They are effectively just holding your own money to give to their heirs later. Participating versus non-participating. Non-participating, everything is guaranteed. Your premium, your death benefit, and the growth of your cash value are fixed from day one. Participating, you participate in the profits of the insurance company. If the company has a good year, fewer death claims than predicted, or better investment returns, they pay you a dividend. You can take this as cash, use it to reduce your premiums, or let it sit in the policy to buy even more insurance. The historical shift: buy term and invest the rest. To understand the third type of insurance, we have to look at the 1970s and 1980s.
During this era, interest rates were skyrocketing, sometimes hitting 20%. People realized that insurance companies were taking their whole life premiums, investing them at high market rates, but only giving the policyholders a tiny conservative return, often 2% or 3%. This gave birth to a revolutionary financial movement: buy term and invest the rest, or BTIR. The logic was simple. Why pay the insurance company $200 for a whole life policy when you can buy a term policy for $20 and invest the remaining $180 yourself in the stock market? By doing this, you build your own reserve fund that you control completely. Eventually, your investment account will be so large that you are self-insured and you can drop the insurance policy entirely. 3. Universal life insurance, the flexible hybrid. The insurance industry needed a way to compete with the buy term and invest the rest movement. Their answer was universal life, or UL insurance. Universal life is a permanent policy, but unlike whole life, it is unbundled. In a whole life policy, the insurance and the investment are fused together. In a universal life policy, the components are separated. You can see exactly how much of your premium is paying for the cost of insurance and how much is going into your investment account. The hallmark of universal life is flexibility. In most UL policies, you can adjust your death benefit or your monthly payments as your life changes. If you have a tight month, you can pay less. If you have a windfall, you can overfund the policy to grow the cash value faster. The 4 main types of universal life. Depending on your goals, you can choose how your reserves are handled. Guaranteed universal life, or GUL, the most term-like permanent insurance. It focuses on the death benefit and doesn't try to build much cash value. It's for those who want a fixed price for life but don't care about the investment. Standard universal life. Your cash value grows based on a conservative interest rate set by the insurer, similar to a high-interest savings account. Indexed universal life, or IUL. Your growth is linked to a market index like the S&P 500. It typically has a cap, limiting your gains to, say, 10%, but also a floor, guaranteeing you won't lose money if the market crashes. Variable universal life, or VUL. This gives you the most control and the most risk. You choose specific mutual funds for your cash value. If the market booms, your policy booms.
If the market crashes, you might have to pay massive premiums just to keep the policy from collapsing. Summary: which tool for the job? Choosing the right life insurance isn't about finding the best product. It's about finding the right tool for your specific financial architecture. Term life is the most cost-effective way to protect your family during your working years. It is simple, affordable, and temporary. Whole life is for those who want absolute certainty and a slow, steady accumulation of wealth that is insulated from market volatility. Universal life is for the person who wants permanent coverage but also wants to tinker with the policy, offering the flexibility to change payments and the potential for market-driven growth. Always remember, insurance companies are conservative. They build these products to protect their own profitability first. Do your own research, be mindful of the sales incentives behind a recommendation, and understand the rules in your specific jurisdiction. In our next guide, we will take this framework and apply it to a practical exercise, calculating exactly how much coverage you need to ensure your family's future is set in stone.